Hey guys, Brian Stevens here. I got Dave Stevens. You all know his resume. It's fantastic. Dave was talking about independent mortgage banks being targeted or potentially being targeted, or that seems to be the sentiment on the streets. And I found it interesting because I've been having conversations about underwriting from a position of fear with mortgage companies these days. And I'm hearing a lot of that. And boy, these go hand in hand. So I wanted to ask Dave, first and foremost, in the article that you penned, you said you talked with a lot of independent mortgage banks and they feel that they're being targeted by the GSEs. Is that your sentiment as well, or are you just conveying a message?
I want to be careful not to accuse the GSEs of something that they may have a better answer for. So I want to give them a chance. But I interviewed a large number of independent mortgage bankers. They put me in touch with their chief credit officers or their senior underwriter, depending what the role is at various companies. And they walked me through those people who are basically data-driven, very controlled roles in these companies. They were careful to walk me through what's going on, how the numbers have increased, what options are being presented to them. And look, in the old days, as it were, through the QC process, if the GSEs found a defect, and remember, I ran the single family business for Freddie Mac for almost a decade, we gave the lenders options most of the time. They didn't always have to be flat out repurchase or pay 5 points, which is an alternative that the GSEs are offering. We'd offer indemnification letters, and sometimes we'd offer them the opportunity to fix the defect. And in this case, what we're finding is IMBs in particular. By the way, the moment that article was published, I got contacted by the key mortgage policy head at the ICBA, the Independent Community Bankers Association, and they represent smaller community banks. They said, hey man, we're in the same boat. So maybe the GSEs are treating smaller banks, which could be undercapitalized or could fail, because that's a big concern right now in the marketplace after what we've seen with Silicon Valley, et cetera, and independent mortgage bankers, which I know the GSEs are worried about counterparty risk, where one, they've stepped up their QC sampling methodology, meaning they're sampling more loans on a monthly basis. And two, they have zero tolerance for defects, and they're forcing, you have really two options. You can buy back, or an alternative to buyback is you pay 5 points, which is a discount to the GSEs, which is the extraordinary price. But that's what the choice is, leaving independent mortgage bankers with no choice. And just to be clear here, this is not how business used to be done with the GSEs. And as I pointed out in my article, at a time when I only quoted one of the GSEs' earnings, but at a time when they're printing billions of dollars in earnings, showing one of the best quarters they've had in years, at a time when the whole industry is suffering, and they posted those earnings in a great manner due to better credit quality, which they call out in their earnings release. In fact, they reduced loan loss reserves because the credit quality is so good. Man, 2 and 2 don't equal 4 here. They're rolling in profits on the backs of these IMBs who drive in 80% of their volume. They, by their own self-acknowledgement, are doing better credit quality loans than ever before, and that reduces their reserves for loan losses in the tune of almost $600 million for one of the GSEs in just a quarter, by the way. And here they are now shoving back all these loans, giving these IMBs no choice but to buy back or pay 5 points at a time when they're struggling just to break even. They're not rolling in billions of dollars of profit. Most of them are losing money. And given the nature of what's going on this year. Yeah, I said at the outset, I don't have the specific data. I'd sure love to see it from them. After writing that piece, I had so many senior executives of independent mortgage bankers from across the country send me personal emails telling me how I nailed it from their perspective based on what they're experiencing.
All right, credit quality is better than it's ever been. Foreclosures all-time low. Cleaner files than they've ever had on book. Is this just a case of a nail or a hammer always finds nails, where everything is so clean that we need to find problems and faults, so they're picking a little bit more closely? They have to scrutinize more in order to find fault?
I think it's more, pardon me, my friends at the GSEs, I think it's more insidious than that.
Wow.
I think the GSEs have been worried about counterparty risk, right? So all their reps and warrants, that the origination, you have a whole bunch of reps and warrants. You have servicing reps, you have origination reps, but all the origination reps and warrants for close to 80% of their business are being held by independent mortgage bankers because they're doing 80% of the volume nationally, and they retain those rep and warrants. There's two risks there for the GSEs, and they're real. One, if the IMB just doesn't make it through the winter, it's going to be a long winter. I've also written about that recently. It's going to get harder before it gets better. I think Q3, Q4, and Q1 are going to be really tough. I think the GSEs know this as well. If an IMB fails, they're not there to back up those reps and warrants, and those reps and warrants are worthless to them. So that's one reality. The second is we're seeing a ton of M&A activity. And, I'm because of my client base, I can't disclose any of this, but there's just a ton of M&A activity going on, merger and acquisition.
M&A? I'm sorry, can you explain M&A?
M&A is merger and acquisition activity. Okay. So we have a lot of IMBs who have hired investment banking firms, which are a variety of around the country. They're pretty consistently working with the independent mortgage bankers who want to sell, and they're pairing them up with buyers who want to buy. Most of the buyers are bigger IMBs or IMBs that are acquisitive right now, meaning they want to grow, but there's a lot of transactions. The GSEs don't like these transactions because they are not mergers, they're pure asset sales. So the IMB that sells itself to the buying company is doing a pure asset sell, and therefore the origination representations and warranties that IMB sold has made, they don't carry to the buyer. The buyer is just doing an asset acquisition, not inheriting their liabilities. And so the GSEs have little to go to. They could try to go back to the seller, the company that sold to the bigger buyer, and try to put back loans to them. But in most cases, there's no capital. There's nothing left. They've gone away. The company's gone, and they've now been bought by a bigger company. So for those two scenarios, I would say I understand the GSE's risk concerns. A similar way for small community banks, they're also saying they're experiencing the exact same thing. What I'm hearing anecdotally is the big banks, I'm not going to do the B of A's, JPMs, et cetera, of the world, they're actually being given options, as I'm told, to in-depth. Because why? Because Fannie and Freddie believe that their capital is here to stay, that they're not going to be sold, and they're not going to fail over the next few years. So no matter how big the cost gets, they'll be able to pay their bill and back up their reps and warrants. So we have a unique scenario. And the concerning part to me, however, is if you talk to the lenders that are getting hit on repurchases, there are two standout reasons why. It's not minor defects that are either indisputable or don't matter. In some cases, they may be somewhat minor. But what they are first, in the QC process, whoever looks at the underwriting of the file at Fannie or Freddie disagrees with how the lender's underwriter underwrote the loan. And usually, those types of buyers are self-employed buyers, families with multiple income sources, people with variable income, 1099, or other forms of income like that. And as you know, it's difficult sometimes, especially if you're looking at with add backs off of Schedule E's or Schedule C's and the kinds of things that a good underwriter will look at when they're underwriting a loan, adding back depreciation or this or that, and the other thing that goes ultimately in determining the borrower's income. And, I used to teach underwriting classes when I ran lending for the savings and loan I worked for the first 15 years of my career. And we had pull everybody into the room, all the underwriters. We'd hand out the same set of tax returns, 3 years worth, to everybody in the room. And we'd have them do the calculations and come back with the income. And then when it was all done, I'd call up 3 different people from the room. They're typically 20 or 30. And I'd have them each, we had whiteboards back then. I'd have them each on the whiteboard, give me their net income for the home buyer. They were never precisely the same.
Right.
So, but the problem is that's what creates defensive underwriting that screws the little guy or the small business owner or the self-employed borrower. It's why lenders are a little bit afraid of them, because that's where a big chunk of the buybacks. And then the other one, Brian, is appraisal. They're challenging appraisal. They call it technically appraisal fraud, but it's not really fraud. It's not intentional.
No,
but they are challenging the appraisers, comps, et cetera. What's ironic about that is in the GSE's earnings, especially the one that I quoted in my article, that's in Housing Wire, in that earnings release when they talked about taking back $500 million worth of loan loss reserves and reclaiming that, which really improved their earnings for the quarter to get them up to $2.4 billion or something like that. They said one of the primary drivers of their better credit quality on their books is the increased equity in their portfolio. So they're shoving back loans back due to appraisal, but They just got $500 million due to equity growth. Now, I get that they need to be, they need to hold lenders accountable. You know, lenders, we have a rule, we used to argue a rule with the GSEs, known or should have known. So but the argument here is, if you knew it, or you should have known it, that information prior to closing, yes, you're accountable for it. But if there's information you could not have known prior to closing, don't come back to me and ask me to repurchase. I mean, not all defects are the same. And when we did all this negotiating over the rep and warrant construct with FHFA years ago under Mel Watt's term with industry, this is when I was running the MBA, we came to an agreement that, look, intentional fraud or misrepresentation, that's a buyback, no question about it. And then we added a second category for fat finger defects, meaning wasn't necessarily intentional, but you keep making the same mistake over and over, and oftentimes it's the same underwriter, and you're not holding that person accountable. You own those loans. So fat finger defects you would have. And then we break down material defects. Materiality was defined as a defect so severe that you would not have done the loan had that defect been made known at the underwriting of the file. And that comes down to known or should have known. There's no way I could have known that information, like the borrower withheld information from me, or it's a data element that there just wasn't in the discovery of the tax returns they provided, the year-to-date income statement, all the other pieces of information. Then that's what a guarantee is for. A guarantee is to protect you as a lender against credit losses, assuming you do everything within your abilities to meet the underwriting requirements of the investor who buys those loans. And you do not commit intentional errors. But they're not doing that anymore, it doesn't appear. They're increasing their sampling, they're kicking back a lot more loans, and they're arguing over things like appraisal and underwriting of self-employed at a time when actually they're getting much better equity on their balance sheet. They're making ridiculous profitability, and they're saddling the industry with these loan repurchases. And again, please, if you're a GSE employee and you watch this, I did acknowledge that there is greater risk with non-banks today due to risk of the counterparty risk concerns that you may have, and the risk of a potential sale if they sell their company. Being a pure asset sale, you losing your reps and warrants. But there's something that's just not right when you're making those record profit,
right,
on an industry that's busting their humps just to stay alive and have lost money almost across the board year to date. Some have made money on a month-to-month basis during June and July or August. But for the rest of the year and for probably the rest of this year, on a monthly run rate basis, the vast majority of them, I think, are going to have a hard time breaking even. So they're making money on these same customers that they're also saying, but I don't trust you. I don't know if you'll survive. So yeah, please sell me your loans, even though I don't trust you, and let me reap my incredible profits that I can put into my capitals every quarter that I print them. Thank you very much. But I'm still going to kick back anything that looks squeaky from my perspective to you. That relationship doesn't seem honest. It lacks integrity to me. And that's what I think, if I were a regulator today, I'd be asking the FHFA to look at a reasonableness standard here and relook at the rep and warrant construct that we all agreed to close to a decade ago at this point.
So just real quickly, honestly, I thought was interesting because I was reading a working paper from the Philadelphia Fed that came out earlier in January, and it was called Owner Occupancy Fraud and Mortgage Performance. And what they referred to was owner occupancy, appraisal, and income calculation as being fraud. And they were comparing back in 2006, 7, and 8, the lead up to the meltdown last time, and the market that we have right now is saying fraud is actually increasing because of these appraisals, because of owner occupancy. And I think that would be one that you'd say a mortgage company might not know. You could say that you're going to occupy a property and then just never occupy that property. And, you can go back and armchair quarterback that thing a year later, 2 years later, and realize it was never occupied and call that loan fraud. And
I think that's a tough one because, I've lived as an underwriter guy. I wasn't just a guy working in Washington my whole career, and many of you have. And we used to look at if someone's buying a new primary residence and they own another residence, which is going to show up on their tax returns as well as their credit report if they have a mortgage on it. We'd then look at their place of employment, the distance from the new home from the old home, we'd really want to validate that really is an owner-occupied purchase. So, for example, if they own a nice home 5 miles from work and they're buying another home, which is going to be their new home, and they say they're going to rent the old home, but the new home's smaller or further away or what have you. I mean, there are ways to narrow down. It isn't a perfection, but there are ways you can begin to narrow down whether that makes sense. And, look, I do have a healthy dose of skepticism about, those in our industry that will, dance along the edge and in order to do a loan. And in desperate times, people will do more of that. So
yeah,
that's a tough one, but that's not what the GSEs are primarily focused on right now. Go ahead.
That gets to my question. Here's a question. If they're concerned about reps and warrants, if they're concerned about some of these smaller independent mortgage banks not necessarily being absorbed, but being dissolved and compromising their position, isn't everything that they're doing by almost weaponizing words, calling things fraud when they could just be a disagreement on how to calculate income, using the equity on these appraisals in one hand to show that they have more equity in their portfolio, all the while saying that it could be fraudulent, inherently fraudulent. But isn't their stance kind of counterintuitive? Because what they're doing with these buybacks are forcing more independent mortgage banks into being dissolved or consolidated by larger firms. So that's the goal?
You nailed it, Brian. I mean, that's really the remarkable point here, is that they're increasing the level of counterparty risk by thrusting all these buybacks back to these lenders who barely are surviving as it is. I spoke to some not huge, medium-sized independent mortgage bankers. Their staff time and the people they have dedicated to reviewing buybacks every month, even if it's just a couple, if you're a small independent mortgage banker, you can get overly consumed with the back and forth with Freddie or Fannie trying to argue the point. And by the way, from everybody I spoke to, one of the GSEs is far more aggressive on this than the other, which I found interesting. You can spend all this time arguing as to why meets the standard, and you'll submit additional information as to why. You'll show your analysis of the underwriting, or you'll relook at the appraisal and audit it, re-audit it, and go back to Freddie Mac or Fannie Mae and tell them why it is the right value. And in some cases, they may win. They may be successful in getting Fannie and Freddie to, pull back on the buyback requirement. But most often what I'm hearing is not. That costs money, right? That whole process costs money. And then add insult to injury, when you have to buy it back, you're not going to go sell it in the scratch and dent market today, because you're going to get haircut on the scratch and dent because it is just that. And most likely it was a lower rate at the time. And so the discount on whatever that mortgage rate is versus current coupon is going to kill you. So that's why most are paying this 500 basis point fee that the GSEs are letting them pay as an alternative. All of this to say is, yeah, I think, the GSEs are far from perfect. I've been quick to call them out. I think they're critically important to our industry, but they are trying to get themselves recapitalized, and they would like to get to the point where they could privatize sometime maybe a decade from now, which is about the path they'd be on given current earnings. That is worrisome to me, because if they're behaving this way in conservatorship, when they have a regulator stop, there's got to be a balance. These are government utilities right now. Put another way is, Ginnie Mae doesn't look at this as a way to print money. Their QC methodology is certainly not, FHA's QC methodology is certainly not as intense as the GSEs are, and certainly the putbacks aren't the same way they as the GSEs are going through right now. You have two companies printing billions of dollars in their own earnings report of the one I quoted in my article. Yeah. It was the third consecutive quarter of increase, and something like 46% higher than the same quarter a year ago. How are they doing so well when everybody else is struggling? Credit quality, good loans on the books. Yeah. And good coupons, and they're, all this other stuff is producing yield. So it's just, to me, it's pretty shocking. In all honesty.
I have one question, and this might come across as stupid, but I know a lot of other people are thinking this thing too. This feels like a policy to me. It feels counterintuitive. It feels like a groundswell coming from different areas, not just the GSEs, the FHFA, but like I said, some of the stuff that I'm reading with the Fed, it feels like a policy. Here's what I want to know, and I mean this. Who's pulling the strings? Who's in charge? This feels like somebody saying, this is what I want. Is it really too many chefs in the kitchen where you've got 10 people making decisions all at once, regulating one industry. That doesn't seem very smart. Who does the buck stop with when it comes to these type of policies? Is there a person behind the green curtain?
No, there's an analyst, in a really well-known analyst inside the Beltway. Everybody reads his stuff. He's with Cohen and Company. His name's Jared Seberg. And he put out a piece on Monday that said, are Washington regulators slowly chipping away at an industry that's going to ultimately result in a credit contraction? And in there, he talked about buybacks. He talked about the new capital rule that's being proposed, which will crush. I hope this is too long a discussion to do today, but the new proposed capital rule is just extraordinarily damaging. And he talked about the Fed and what's happened with the price reaction to the inflation that they created and how that's impacting the marketplace. He talked about CFPB engagement. He talked about FSOC in their meeting 2 weeks ago, where there was a presentation given at that Financial Stability Oversight Council, which is attended by the White House, Treasury, the Fed, OCC, FHFA, CFPB, everybody, they all attend FSOC. And there was a presentation given by FHFA, the Treasury Department, and Ginnie Mae on counterparty risk of non-bank servicers. So we have all this scrutiny coming in from all these various places, and there's nobody in charge. I'm just going to repeat what you and I talked about this in a previous interview about this is my concern with the administration. The role of the FHA, the role of the HUD secretary, once upon a time would have had far greater authority. They were the regulator of the GSEs. Prior to the HERA legislation in 2008, the regulator for the GSEs reported up to the HUD secretary. They had all the regulatory oversight stuff that the CFPB now has. The Office of Regulatory Enforcement was at HUD under the FHA commissioner, and that all went away. We don't have a single source with authority that's overseeing all the crap being piled onto the industry. So instead, we got FHFA, an independent agency with a director who is at will of the president, but it is an independent director, not a cabinet level position. They cover the GSEs and the federal home loan banks. You have HUD, obviously, they have the FHA program and Ginnie Mae, but then the VA and the USDA are two entirely different programs. You got the Fed managing what's going on with interest rates. You got the Treasury, which is a really critical cabinet role to the president, the Treasury Secretary, who could have a big impact on pushing a lot of these decisions, but it's too focused on other things in terms of the economy. And yet all this crap, then we have the CFPB, which was created in 2011, early 2010. No, 2011, I guess we finally implemented it. Was when Dodd-Frank finally was passed and put into place. And so those rules are all coming from this brand new regulator we created, none of whom are accountable to any other. They're all independent. They all can make independent decisions. And then add on the banking regulators, the FDIC, the OCC. I mean, this is just crazy. It is really unbelievable, the piling on effect. This piece by Jarrett was really good. I'll send it to you afterwards. I'm not sure you can read it because you have to have the subscription, but you can read the summary. But it's incredible. And to your point, all of this is happening because there is no one saying, guys, we got to get coordinated here. We need to think about the cumulative impact of everything we're doing here through all these various agencies and the institutions they run to the housing sector, because we're crushing the living daylights out of it. And that's what's happening right now. And it's not hyperbole, guys. I mean, I called for I got an email off of telling me, Dave, I always believed in the housing czar that you called for. I never called for a housing czar. I didn't like the word czar, but yeah, we don't have someone that is a direct report to the president who has authority of a cabinet level person whose sole job it is to make sure that all of the institutions are at least talking to each other and recognizing the ripple effect of whatever they do and how it could affect the other regulators, because that's a real challenging point.
They're all just like a school of little silverfish in the middle of the ocean that turn at the same time, It's striking, though, how all of these agencies and groups are coming up with the same type of dysfunctional policy at the same time. It's like, who's pulling the strings on this thing? But, I mean...
Well, it's just funny in the mortgage world because IMBs became a big hot topic, I don't know, several years ago. I would say towards the end of the Obama administration, frankly. And it was institutions like Ginnie Mae and others whose their heads would make speeches about concerns over independent mortgage bankers. What kills me about all of this is, yes, some IMBs may close and sell. In terms of impact to Freddie or Fannie on any individual one of these companies, it's a rounding error. It's a fraction. It has no impact. Now, if Quicken were to go down, or United Wholesale, or Wells, or B of A, or JP Morgan, or one of those guys were to have problems, like we saw during the 2008 housing recession, that could have an impact. But IMBs never cause problems. If you think back to the Great Recession of '08, name me anybody other than Taylor, Bean, and Whitaker that was sizable enough to cause even a second look from the administration. This year, post-COVID, in the new crisis that's been created by the Fed by raising rates because they're trying to fix the problem they created by lowering rates too fast right after COVID and hyperinflating the economy. So the Fed has created this problem. They're now trying to fix it by raising rates.
Yeah.
That's the reason Silicon Valley Bank failed. They had invested in long assets like mortgages and long treasuries, but their deposit rates were rising because short rates were going up due to what the Fed was doing. And today I just heard a report about how this is not over. The bank ratings are coming out, and it doesn't look good because there are many banks across the country that are in trouble due to that basis risk, the basis imbalance between lending long and borrowing short. They created the problem. The bigger risk is in the banking sector, and it always has been, as it was during the Great Recession, as it was during the savings and loan crisis in the 80s, and as it has been this year in terms of some of the biggest bank bailouts in the history of our country. Why the hell are we focused on a sector of the economy that's actually doing more affordable lending for America? Really won't impact the balance sheet, any one of them, other than a few of the handful at the very largest side of that sector, and forcing more risk onto them through policies like the GSEs are implementing, particularly when they're printing so much money. I mean, I use this analogy. It's like the king collecting taxes and making his poor minions hoe the fields and grow crops for he and his family. It's a robbing Peter to pay Paul kind of scenario here. We're really screwing the folks who really do the work and provide the loans, and keep the real estate community functioning so that they can provide solutions for their home buyers. And the GSEs are just not making it easy. And I'm a big fan of the GSEs and the role they play, but someone's got to control the bad stuff they do. And while the FHFA was willing to jump in and make them change their LLPAs, thinking that was going to somehow change the whole paradigm of minority lending, which they suddenly had to modify the DTI and all that. It's great to focus there, and they adjusted. They should be focused here. People have been screaming about it, and I'll just give you one last point. I believe the MBA took a bunch of lenders in to meet with the FHFA months ago on this subject, and nothing's been done. That's my loan rep assistant out there.
Yeah, it's even got dog riled
but
up.
nothing's been
That's the thing.
Yeah, exactly. So it's a really amazing time, and I think for all of you, there are things you can do. I mean, okay, I always say activist. You need to be an activist in our business, or you're going to get the worst side of what policymakers do
Right now,
Get involved with your trade group, whatever it is, CHLA, NAM, MBA, your state mortgage lenders association. Make it an issue. Make the head of your state association do something about this. I talk to broker groups all the time, and we have the same conversations, because whether you're a broker or a mortgage banker listening to this kind of episode that Brian's hosting here, you're all going to get impacted by this downstream, because if the lender takes the buyback, you can be absolutely certain it's going to begin to impact how they look at your loans, and that's just not a good outcome.
Okay, last question here. If this is just all speculation on your part, but I'm going to ask you, if we stay the course right now that we're on, and we do see a dark cold winter, as you suggested. And frankly, as the Fed is telling us this is going to happen, we're staying the course until inflation gets to 2, and their projections say it's not going to happen until 2026. That's what they're saying. But if we stay the course with these type of policies, what percentage of independent mortgage banks are going to go by the wayside by this time next year?
It's okay. Just a couple points. If you listen to Powell last week during the interview, when they raised rates, was that last week or the week before? It's all escaping me at this point. 2 weeks ago, I listened to the press conference afterwards, and he does not intend to keep tightening until he gets to 2. In fact, he said explicitly during the press conference, the Fed does not intend to intercede in the markets to get to 2. He said that would be overshooting. We were at 2.4% inflation on the last report. It might be a little worse this week. Let's see what happens. But it was at 2.4%. We're pretty much at a point where if we could keep inflation at this level, this range, the Fed could easily do at minimum, probably the most one more increase, maybe no more, because Powell does not want to overshoot that. His point is that whatever the CPI rate is today, that reflects activity from 2 to 3 months ago. So if you tighten too far, you're going to blow through your 2 and end up in a true deflationary recession. So that's a problem that he wants to avoid. He's really trying to balance that soft landing. So he's not going to keep tightening until 2026. Nevertheless, Nevertheless, it's going to be a really hard winter. We are still oversupplied with lenders and loan officers. We have too many for the demand, and it's not helping with high rates. It's scaring away more demand than that's needed. And it's scaring away more sellers from coming to market because they don't want to sell their home with a 3% mortgage to get a 7% mortgage. So all of this has to come to pass. And so I think Q3 and Q4 and Q1 are going to be particularly hard because home purchase markets are cyclical, right? We know that. You have a spring market, decent summer, sometimes a fall bump, but in the winter, the cyclicality really hits hard. So we're heading into that time frame. You just got to prepare for it. Doesn't mean you shouldn't keep working your butt off and that there won't be deals going on, but it's going to be a slower point of the cycle. During that time, we're going to have a lot of people finally say, that's it, I'm done. I can no longer hang in. I'm throwing in the towel. And they'll either sell, they'll close. And for individual loan officers, I think there's still a ton more that are low producers now and are going to, by wintertime, they're going to be like, I got to go find another job doing something else. And we've seen that in other cycles, Brian, going back over the other corrections we've lived through. I believe by the end of first quarter next year, we will have really right sized. I think we'll be at bottom. And if you look at the forecast data for home purchase activity next year, along with the interest rates forecast, it's definitely more positive than 2023. And I think 2024 and 2025, all in, we will have better years. All of us who survive in this winter we will have better years over the next couple of years. Unfortunately, we've had decent few months here in the summer that kept us going, but I think for a lot of people, it's going to be a slower winter, and we just got to be prepared for that.
Well, Dave, thank you so much. I appreciate everything that you shared with us today. For those of you who are watching, make sure you subscribe. All the links down below for Dave and his company are below this video. We're also going to put Jared Seberg's information down there as well, so you can check out anything. And of course, when Dave gets me that article or information on it, we'll certainly go ahead and post that down below as well. Thank you so much for your time. Are you still riding motorcycles?
I've been riding motorcycles since I was 16 years old. I've never not had a motorcycle, and I finally sold my BMW.
You know, I'll tell you what's fun if you haven't already done it, and a lot of people are experiencing this. But go get an electric bike and try not smiling. Just ride an electric bike and smiling. It's super fun.
I've really thought about that. That's a good idea.
Hey, Dave, once again, thank you for all your time. Appreciate it.
Okay, great being with you, Brian.